Hey everyone, welcome back to another dividend investing video. Today, we're diving into two dividend stocks that have faced a serious hit lately. These companies have been through a tough time, and it's left many investors questioning what to do next. I'll briefly walk you through what's going on with these companies, the risks involved, and what this could mean going forward. Stick around to find out whether these stocks are a hidden opportunity or a red flag you should avoid. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. The first company I'm going to go over today is Comcast, ticker CMCSA. This is the company I hold in the Dividend Growth Income portfolio. It's a portfolio I'm growing and sharing here on the channel with you guys. Comcast is the global media and technology company offering broadband internet, wireless phone services, and home security solutions through its Xfinity brand. The firm also owns the streaming platform Peacock, Universal Studios theme parks, and NBC Universal's film studio. On Thursday, January 30th, shares of Comcast fell over 10% after the company reported worse than feared subscriber losses in its core broadband internet business, which drives over 80% of Comcast's profits. The expectation was already pretty ugly, with a projected subscriber loss of 100,000. However, the actual losses were even worse, 139,000 net losses of subscribers. In reality, this is a tiny portion of Comcast's subscriber base of about 32 million. But it points to a future where Comcast could face stiffer, more intense competition. Now, if you have been a customer of Comcast, you might feel like you have little to no other choice. What you're dealing with is essentially a monopoly. However, advances in fixed wireless access, as well as fiber to the home broadband, are changing the game. And they have the Peacock streaming services to compete with the likes of Netflix and Disney. But over the last quarter, subscriber growth has stagnated. They did not lose subscribers, but they also didn't gain any, keeping the total paying users at 36 million. Are these short-term setbacks, or are we looking at the beginning of a decline? Comcast has also made the decision to sell off its cable TV properties into a spin-off company that for now is dubbed SpinCo. This includes USA Network, CNBC, MSNBC, Oxygen, E!, Sci-Fi, and The Golf Channel. I can't see much value in holding on to these channels, so I think it's a good call on Comcast's part to shed the majority of its cable TV assets, and if I'm still holding Comcast when the spinoff occurs, I'd plan on selling off the shares of the spinoff company. I have no interest in those. So given the challenges that have been facing Comcast, SimpliSafe Dividends downgraded Comcast's dividend safety score from 89 to a score of 80, from very safe to safe. So there still may be something here for people who want income, and Comcast has quite the track record. If you want to hold this for the dividend, it's available for about as high of a yield as we've ever seen. This can be a blessing if it works out, or a massive red flag. Right now, shares are yielding almost 4%. That's at 3.92%. This is massively above the 5-year average dividend yield of 2.61%. And this big of a spread is usually a sign of something gone wrong. Granted, Comcast's dividend payout ratios have been consistently kept low. Currently, the dividend accounts for just 31% of forward earnings and 55% of forward free cash flow. So things would have to go seriously south before this dividend's actually in any real danger. But we must also take into account their debt situation. Comcast has a net debt to capital ratio of 52%, which is on the high side. However, these numbers are fairly typical for Comcast from a debt perspective. It's nothing unusual for them. And Comcast has maintained a strong track record of dividend growth over 17 consecutive years of increases. Over the last 5 years, the dividend has grown at an average annual rate of 9%. And their latest raise was announced on January 30th, increasing the quarterly payment from 31 cents to 33 cents per share, a 6.5% increase over the last year. The next ex-dividend date is April 2nd, giving investors plenty of time to decide if they want to secure the next dividend payment of 33 cents per share on April 23rd. Comcast follows a January, April, July, and October payout schedule, with the current annual dividend totaling at $1.32 per share. So Comcast looks undeniably cheap right now, trading at a price-to-earnings ratio of just 7.7, well below its 5-year average of 11.3. It's also trading at a significant discount compared to the sector average of 17.8. Shares have dropped 27% over the last year, and Comcast is hovering around its 52-week low. So while Comcast is undervalued, it's for some very clear reasons. SimpliSafe Dividends compared the company's situation to a very large but slowly shrinking ice cube over the long run. And I think that analogy is spot on. While I believe the dividend remains secure for now, I'm not convinced Comcast is the best place to invest your money for the long term. There's so many other strong opportunities out there, and for that reason, I'm seriously considering selling my Comcast shares, reallocating that capital into a higher conviction investment. I already have something in mind, but I think that's just a topic for a future video. With that said, Wall Street analysts have an optimistic one-year price target on the stock of $43.99, which represents 30% upside from today's share price. So perhaps there is some money to be made. Who knows what will happen? What about you? Are you a Comcast shareholder? Do you see this as a good opportunity to buy a beaten down company that could turn things around? Crazier things have happened. So do you think Comcast is a buy, a sell, or a hold? Let me know down in the comments below. The next stock I want to talk about that's just been spanked over the last few years. We're talking about United Parcel Service, ticker UPS. And we're talking about the world's largest package delivery company with a network of over 130,000 vehicles and more than 550 aircraft. UPS provides customers with convenient and cost-effective shipping options worldwide, delivering millions of packages each day. UPS also offers freight forwarding, logistics, and supply chain services. Over the last 12 months, shares of UPS are down nearly 20%, and today, shares are trading at their 52-week low. The stock has been on a steady decline over the last few years. In fact, shares have lost about half of their value since early 2022. On January 30th, shares plummeted after the company projected annual revenue well below expectations and made it clear that the anticipated turnaround in their business would not arrive this year. They also announced they were slashing their business with Amazon, their largest customer, by half. CEO Carol Tomé put it like this: Amazon is our largest customer, but it is not our most profitable customer. The plan is to reduce business with Amazon by 50% by June of 2026. Amazon at this time makes up 12% of UPS's sales in 2024. It's about $11 billion of its $91 billion in revenue. Following these announcements, shares had their single worst performance day since October 10th, 2028. One of the biggest challenges UPS faced recently has also been the rising cost of labor. In 2023, the company reached a new 5-year labor contract with the Teamsters Union, covering roughly 340,000 workers. While this agreement averted a major strike, it significantly increased UPS's operating expenses. The deal included higher wages, improved benefits, and better working conditions for the employees, which UPS estimated would add about $6.5 billion in annual costs over the life of the contract. These higher labor costs have weighed heavily on profits, making it more difficult for UPS to expand margins and grow earnings in the short term. Investors have been concerned about whether the company can offset these increased expenses through price hikes, efficiency improvements, or higher package volumes. This added pressure, combined with weaker demand for shipping and logistics services, has made UPS a tough stock to own lately. On January 30th, following the news of UPS's shift away from Amazon and lower than expected revenue projections, SimpliSafe Dividends reassessed the company and downgraded its dividend safety score from 69 to 60, moving it from safe to borderline, suggesting there is a moderate risk of a dividend cut. UPS's dividend situation is becoming increasingly concerning. The company's elevated payout ratios, with the dividend consuming 83% of earnings and a staggering 93% of forward free cash flow, suggests that its ability to maintain and grow this dividend is under pressure. The turning point was this massive 50% dividend hike in 2022, which saw the quarterly dividend jump from $1.02 per share to $1.52 per share. And at the time, this looked like a strong commitment to returning value to shareholders, but in hindsight, it now appears to be overly aggressive, maybe even trying too hard to attract dividend investors. With revenue growth stalling and profitability coming under pressure, UPS has been forced to slow dividend increases to just a penny per year, a clear sign that management is trying to rein in excess payouts. Adding to these challenges is the lack of earnings and free cash flow growth. UPS is struggling with stagnant revenue, rising costs, particularly from its new Teamsters labor contract. And without stronger financial performance, the dividend could become increasingly difficult to sustain, raising concerns about whether a cut might be necessary down the line. And maybe that's what will have to happen before things turn around for UPS. Shares are yielding a historically high 5.71%, while UPS has a 5-year average dividend yield of 3.48%. Now, to me, this is just a massive red flag. There's way too many indicators that suggest we could be looking at another Intel or Walgreens situation. Wall Street isn't optimistic either. The average analyst price target for UPS is $134.59, a level it was trading at just about a week ago before publishing this video. Today, shares are trading around $114. I'm not sure there's an easy answer with UPS. It's not a stock I'm going to be recommending here on the channel, but I have been wrong before. Personally, I'm not excited about investments in either Comcast or UPS right now. Whether as a dividend growth investor or a value-minded investor, I just think there's better opportunities with considerably less risk. While I think Comcast can remain a relatively reliable dividend-paying stock for the years to come, I'm less adverse in holding that one. Right now, I just wouldn't touch UPS. That's just my personal stance, not investment advice. Let me know down in the comments what you think about these two stocks that have been in the doghouse. There's always a chance things could turn around and change my mind. But for now, I'm looking at other investment opportunities. If you want to see what stocks I purchased in January of 2025, just last month, click on this next video where I cover every single purchase I made in both my Roth IRA and my taxable dividend growth income portfolio. Until next time, my friends, thanks for watching and keep investing.